we just make the entry as depreciation to income statement or profit and loss account? No. Entry would be, you create a contra account or the opposite account for the asset, and you call it as accumulated depreciation. So if asset increase, debit, and if it's contra account accumulated depreciation increase, it means credit. So entry would be expense to accumulated depreciation. Expense increase, debit, accumulated depreciation increase, opposite to asset, credit. So our answer would be here, depreciation to accumulated depreciation. Now again, repeating that question, why we create this accumulated depreciation? We can also say that depreciation expense to truck, because truck value decreases, decrease in truck mean credit. This makes sense, and this is logical, you know. If we don't set up the accumulated depreciation, this is a logical entry. Expense to truck, that's it. But we create contra account for accumulated depreciation. So the reason is to set up this accumulated depreciation, because in a business, we don't have just one asset to depreciate. We have building, machinery, plant, vehicles, equipment, fixtures, furniture, land improvements. So in a factory or in those businesses which rely on buildings, not online stuff, buildings, so they do have a huge depreciation expense. Building is depreciating, vehicles are depreciating, equipments are depreciating, fixtures are depreciating, furniture, computers, trucks, Xerox machines. So they want to know that how much, total depreciation is. And they want to know that how much, the life of the, in this case, truck, how much we consumed this truck, right? And how much is the life of the truck left, whether it's time to replace the truck or not. So for example, if we are here at 6, so you see on 6, the accumulated depreciation becomes 32,000 and value of the truck right now is 9,000. So it gives you the idea that, okay, now times come, we need to replace our truck next year, because next year 8,000 from this 9,000 will go as depreciation and 1,000 left. It means life of the truck is over. So we create accumulated depreciation so that we know that how much assets in this overall business we have consumed, right? Or to put it into a very nice accounting definition, how much these assets have used to generate the revenue. Of course, we are running our business to generate sales. If I am sitting here, so that the chair I bought it here, the table I have, the computer I have here, it is increasing my sales. So I'm selling my skills, right? So we can also find out that this chair that I bought it here, movable chair, right? It is increasing my revenue, right? Of course, my employment as well. So this is the other perspective of finding out the, the definition of usage of the assets, right? So whenever the assets are used, its accumulated depreciation increases, its book value decreases. So what is the book value? Simple. Value of the assets minus its accumulated depreciation. That's it. So here we go. So we have an example here. So I want all those participants who are watching this online, please pause the video here and then try to solve it by yourself. So those who are, we have a live class here. So let's do it together. So FedEx sorting machine that cost $10,000 with a useful life of 5 years. A residual value of 2,000 was purchased on January 1st. So what is the straight line depreciation each month? So what is the formula? Cost minus usage salvage value or residual value divided by number of useful life in years. So answer would be 10,000 minus 2,000 residual value. 8,000 is the depreciable value divided by life. Answer would be 1,600 per year. If the question asks you per month, then divide further this 1,600 to 12, right? So pay very close attention to what the question is asking. Depreciation per month or depreciation per year. So answer is 1,600. So we have now learned the first method, straight line, and now the unit of production method. So in units of production method, in which life is given in terms of units that or how much this asset will produce till its life. So let's just talk about the question here. So we have given the cost of the truck, residual value, and its life in terms of units produced, production units, or the miles it will run during its lifetime. So you see here it is so its formula is cost minus residual value divided by useful life in units. So you see here, what is the angle?
Prorata. It's like the percentage according to the time. But with
No.
the prorata, it was like the percentage according to the total amount.
It's not the percentage, it is number of per mile. It is not a percentage, it is number of per mile. So it means if a truck will run per mile, its value goes down to $0.4 per mile. So if the question says, do we have the question? Yeah. So let's talk about the illustration here. So we know that 0.4 mile is the per unit depreciation, right? So assume that FedEx expect to drive the truck 20,000 miles during the first year. So first year, the value of the truck goes down to 20 multiplied by 0.4, 8,000 a year. Next year, 30,000 will run. The miles, we're talking about the miles. So second year, it will run 30,000 miles. So 30,000 miles multiplied by 30,000, answer is 12,000. So look at that. In third year, 25,000, 25,000 multiplied by the 0.4, answer is 10,000. And then 10,000, 15,000 fourth year, 10,000 fifth year. So you see something that its yearly expense, the depreciation expense, is not smooth, is not straight. 8,000, 12,000, 10,000, 6,000, 4,000. It started increase and then go down. Not smooth. Right? So that's why we don't call it straight line method. Although its formula looks like straight line method, see? Its formula looks like straight line method, cost minus residual value divided by useful life, but in units. Its formula looks like straight line method, but answer is not straight line. So that's why we don't call it straight line. We call it units of production method. And its yearly depreciation expense is not smooth according to number of miles it runs, number of units it produced. See that? Okay. So what is the entry? So the entry to record depreciation for the year ended 12 The year ended 12/31st, 2011. Answer would be depreciation expense to accumulated depreciation. Entry is the same, only values differs. In straight line, the entry is the same, depreciation expense to accumulated depreciation expense, but value changes. Now the double declining method. Double declining method, it is the double of straight line method, simple. Or you can say that its value is 1 over useful life multiplied by 2, simple. And remember, it is also in years, right? Like straight line method. What is the formula for straight line method? Cost minus salvage value divided by useful life in number of years, right? So double declining method, it is just 1 over useful life n. This is the formula. So it means we find out some percentage here. Just multiply the percentage of the cost. There's a trick here, and we will be learning this trick here. What is the trick here? The trick is, so we find 40% here. So what is the trick here? The trick is the residual value is 1000. It means at the end of 5 years, which is the residual value, the useful life, at the end of 5 years, the value must be equal to 1000. And the value, this is the value on the books, right? We purchased it for the 1000, right? And at the end of 5 years, its value on our books would be 1000. So our last year depreciation would be according to our salvage value. So now let's just talk
From
about
the
it.
beginning, we have to remove the 1000 and then we do the depreciation per year, right?
No,
So we keep the same amount of year and the same value, but at the beginning, we already removed the 1000 from the equation, right?
no.
Okay.
Let's just talk about this. So there's a trick here. Let me just remove the mess here. So we'll do all this one by one. So in straight line method and in units of production method, we multiply with the depreciable value here. But in double declining method, we multiply it with the cost, right? In straight line method, right, we have the value here, but that value is based on depreciable asset, which means in this cost minus the salvage value. Answer here would be 40,000, but now here answer is 41,000. It means only cost would be here.